Welcome to the deep dive. Today, we're tackling central banks. Bit complex, right?
Definitely can seem that way.
Yeah, but understanding them is pretty key if you want to get a handle on, well, everything financial, interest rates, your money's value.
It all connects back.
So we've waded through a lot of info, and our mission today is simple. Pull out the core stuff. What do they do, and why should you care? Let's dive in.
Sounds good. They might seem distant, but their impact is very real, very personal.
Okay, let's start right at the top. What are the absolute main jobs of a central bank, like the fundamentals?
Okay, think of them as the guardians of the economy's financial plumbing.
Guardians. I like that.
Yeah, so their big tasks are controlling the money supply, how much cash is floating around,
Yeah.
acting as a lender of last resort, basically,
Yeah.
bailing out banks in a short-term pinch.
Uh-huh. The emergency backup.
Exactly. Also, overseeing the whole banking system, making sure it's stable, and managing the nation's currency.
Gotcha. So when we hear about interest rates moving, how does the central bank actually, pull those levers?
Well, their main tool is usually the policy rate. You hear different names for it,
Yeah.
but it's the rate commercial banks use to borrow from the central bank itself.
Okay.
So if the central bank raises that rate, it gets more expensive for your bank to borrow.
And they pass that cost on to us.
Bingo. On loans, mortgages, you name it. A small tweak at the top ripples all the way down to you.
And this rate fiddling, that's their monetary policy, yeah. What's the grand plan behind it all?
The main goals are usually twofold. Keeping prices stable, so fighting inflation.
Making sure our money keeps its value.
Right. And supporting full employment or, a healthy job market. They try to balance those two.
How? By speeding up or slowing down the economy?
Essentially, yes. Lower rates can encourage borrowing and spending, give things a boost. Higher rates tend to cool things off if inflation's getting too hot.
Okay. And then there's this term quantitative easing, or QE. What's the quick version of that?
QE. That's like a less conventional tool used when just lowering the main interest rate isn't enough, usually in a big downturn.
Like after the 2008 crisis?
Exactly like then. The central bank basically creates new money digitally and uses it to buy assets, like government bonds, from commercial banks.
Injecting cash directly into the system.
That's the idea, to push down longer-term interest rates and hopefully encourage lending and investment.
Got it. Now, there's always talk about central bank independence. Why is it seen as important to keep them separate from, say, day-to-day politics?
Well, the core argument is objectivity. You want monetary policy based on economic data and long-term stability, not short-term political wins.
Because a politician might want low rates just before an election, even if it causes inflation later.
That's the classic concern, yes. Independence is meant to shield them from that kind of pressure, letting them make potentially unpopular but, necessary decisions.
Makes sense. And speaking of inflation, how direct is the central bank's role there? Is it their main battlefield?
It really is. Raising interest rates is their primary weapon against inflation. It makes borrowing pricier, slows spending, cools demand.
Puts the brakes on rising prices.
Hopefully, yes. And the reverse is true, too. Lowering rates can help nudge inflation up if it's considered too low, though that's often harder.
What about when things go really wrong? A financial crisis hits.
Then they step up as that lender of last resort we mentioned. They provide emergency funds, liquidity, to stop solvent but illiquid banks from failing.
Preventing panic from spreading.
Exactly. Keeping the financial plumbing from freezing up entirely. It's about system stability.
And why do they hold big stockpiles of foreign money, these currency reserves?
Reserves. Several reasons. They can use them to influence their own currency's exchange rate if it's moving too much.
Like buying or selling their currency.
Yes. And it helps smooth out international trade payments. Plus, it's a buffer against external shocks, a safety cushion.
And you mentioned overseeing banks. That's regulation, right?
Absolutely. It's a huge part. They set the rules, how much capital banks need, what kinds of risks they can take. They run stress tests.
Seeing if banks could survive another crisis.
Pretty much. It's all about ensuring the banks you use are safe and sound, protecting depositors and the wider system.
Okay, last big topic. Technology. Cryptocurrencies, digital payments. How are central banks adapting?
That's the million-dollar question right now, isn't it? They're studying it intensely.
Thinking about launching their own digital currencies, maybe?
Some are, yes. Central bank digital currencies, or CBDCs. They're also figuring out how, or even if, they can regulate things like Bitcoin and what all this means for their control over money. It's a massive challenge.
So wrapping up, it really sounds like central banks are these crucial, often invisible architects trying to keep the whole economic structure stable.
That's a good way to put it. Vital institutions, constantly juggling stability, growth, and now adapting to a rapidly changing digital world.
It really makes you think. With finance going digital so fast, what is the single biggest challenge for them going forward? Maintaining control, ensuring stability. Definitely something to ponder. Thanks for breaking it all down.
My pleasure. It's crucial stuff.